This is a demonstration of exercise 625, applying and analyzing inventory costing methods. At the beginning of the current period, Chen carried 1,000 units of its product with a unit cost of $32. A summary of purchases during the current period follows. Also during the current period, Chen sold 2,800 units. So the problem gives us the beginning inventory and unit cost as well as the purchases that were made during the period. To determine the total available units, we take the sum of all of the units that were purchased as well as the beginning inventory, and we sum all of the costs so that we have total units available and total cost of goods available. In part A, it says assume that Chen uses the first in, first out method and compute both cost of goods sold for the current period and the ending inventory balance, and use the financial statement effects template to record cost of goods sold for the period. So the first thing that we want to do is to determine the number of units that we had left at the end of the period. So we know that we had 4,800 units available for sale, and the problem stated that we sold 2,800 units. So that means that we had 2,000 units left at the end of the period. Under the first in, first out method, we assume that we sold the first units that were purchased as inventory first, and the ones that are left are going to be our ending inventory. So we have 1,200 units at $41, and we have 800 units at $38 that are left in our ending inventory at the end of the period. So we had 2,000 units and ending inventory of 79,600. To determine cost of goods sold, we take our total goods available for sale minus our ending inventory, and that gives us cost of goods sold. The problem also asked us to record the effects of the cost of goods sold in the financial statement effects template. We know that when we record our cost of goods sold, we reduce our inventory, which is a non-cash asset, and eventually our cost of goods sold, which is an expense, will flow through to retained earnings, which will reduce earned capital. On our income statement, our expenses, which is cost of goods sold, would increase and our net income would decrease. In the B portion, it says assume that Chen uses the last in, first out method and to compute both cost of goods sold for the current period and the ending inventory balance. So under the last in, first out method, we assume that the last items that were purchased were the first ones that were sold. So the ending inventory is going to be made up of the oldest items, the beginning inventory of 1,000 at 32 and then another 1,000 at 34. So we'll compute our ending inventory under last in, first out. Now our ending inventory is much smaller because it was the older cost, so it's $66,000. When we subtract that from our total goods available for sale, we get our cost of goods sold of $106,800. The C portion of the problem says assume that Chen uses the average costing method and to compute both cost of goods sold for the current period and the ending inventory balance. To determine the average cost, we first have to get the average cost per item. So we take the total cost available during the period and we divide that by the total number of units available during the period. And that gives us our average cost per unit of $36. Then we multiply that amount by the number of items that are left in the ending inventory, which is 2,000, to get ending inventory cost, and we multiply the number of units that we sold by the average cost to get cost of goods sold. The D portion of the problem asks us which of these three inventory costing methods would we choose to first reflect what is probably the physical flow of the goods. We do not know exactly what the business was that Chen has, but most companies do sell their oldest products first, especially if they sell items that are perishable or inventory that is likely to become obsolete quickly. Therefore, the first in, first out method does reflect the actual flow of inventory for most businesses. The B portion asks us which of the three inventory methods would we choose if we wanted to minimize income taxes for the period. When prices are rising, which they were in this problem, last in, first out produces the highest cost of goods sold and the lowest net income. When we have lower net income, it results in lower taxable income and income taxes. So last in, first out would be the inventory method that we would choose. In the C portion, it asks which of the three inventory costing methods would we choose to report the largest amount of income for the period. Well, when prices are rising, as they are in this example, first in, first out produces the lowest cost of goods sold and the highest net income. And that is the conclusion of the demonstration for exercise 625.